Hi guys, good afternoon and welcome to CNBC-TV18's Mumbai Newsroom. I'm Pavitra, with me is Sonal, and you're tuned into a very special episode of Mutual Fund Corner. We've been talking about this all through the morning. The Finance Bill 2023 amendment has come through, and that says that mutual fund investments where not over 35% is invested in equity shares of Indian companies will now be deemed to be short-term capital gains. This applies to investments made in or after April 1st, 2023, and will impact flows, like we've been saying, into debt funds, into gold, into international funds as well. Sonal, we've been speaking to experts on this through the morning. I think everybody agrees that this has come as a huge blow to the debt category. And we have, of course, Kirtan with us to answer, how much of an impact it would really be. But, also a lot of viewer queries have come through on this.
We do. And Kirtan, thank you for joining us in the studio. We also have Mohit Gang, who's the Chief Executive Officer and co-founder at Moneyfront. So, gentlemen, thank you for joining us. It's been a crazy day, for lack of a better word. We are continuously getting the amendments as far as the finance bill is concerned, but let's stick to the biggest news that caters to our audience on the show as well. Mohit, let me come to you first up, because we know that it is a blow to debt mutual funds. Just some numbers, can you tell us how big of it is as a segment in the overall mutual fund industry, and which are the funds other than debt funds or the categories which get impacted here?
Yeah, sure. Thanks a lot, Sonal and Pavitra. Always a pleasure to be on your show. And thank God it's Friday, so we can gulp down the news over the weekend. Non-equity AUM in the industry is roughly around 17 lakh odd crore, out of which approx 60% is held by corporates, and the corporate money is mostly short-term in nature. To my mind, that won't get impacted to a very large extent because of this. The retail HNI money put together is roughly around 30 to 35 odd % of this non-equity AUM, which will hugely get impacted. Not the existing flow, but the new flow which will come in, that's what will get impacted. The existing flow continues to enjoy the indexation benefit and continues to enjoy the previous tax regime. But other than debt, I think the other categories which are significant categories, let's say the international fund category or the overseas category, which is roughly around 25,000 odd crores, will get hugely impacted. Any which ways that category has been struggling because the limits were kind of busted a year back, and RBI hasn't raised the limits. Given the pressure on currency, that was very unlikely, but now this new taxation coming in will again hit the category very highly. So that's one category. The gold category or the commodities category per se, which is the gold and silver FOF and the ETFs category, that's again around 20,000 odd crore kind of category, which to my mind will get hugely impacted. And I think it's a clear move to move gold assets into SGB or into even the second level impact might be that it just moves into physical gold because of this. But I think these are the three categories which will get hugely impacted: the FOFs, the overseas, the gold, and obviously the entire debt category.
All right, that is on the immediate reading of this. Kirtan, coming to you now, we have been talking since 6 o'clock in the morning because of everything that's gone down. And, the key point is that indexation benefit was one of the key reasons, right, that people would look at these categories in the first place, whether it's debt or gold or international. Where do you see money moving from here now? Mohit pointed out a few, but you take us through where do you see money moving immediately? Is it the hybrid category? Is it straight up gold?
I think, Pavitra, like you rightly said, that the prime reason why most of this money was coming to debt mutual funds, or even for that matter gold, was indexation. And if you take indexation away, while there are multiple other benefits, but those are not going to appeal the retail investors as such, right? So you and I probably in this room may discuss that mutual funds will give us liquidity, which is better than a fixed deposit, or gives us diversification, which is better than fixed deposits. But I don't think that really appeals the retail investor. The retail wants to see a very clear-cut difference in why do I invest in debt mutual funds versus a fixed deposit, and that's primarily gone for, right? So when I talk about mutual funds, I think there are two things on the debt side. First, if there is a sophisticated investor, that sophisticated investor might still want to stick to debt mutual funds, and I'll tell you why. Let's say if we look at the SBI 1-year fixed deposit today, it is 5.75. The same SBI liquid fund is 7.17, right? SBI is just a context for discussion, right? So there is still a very large spread, because what will happen is that when you invest in mutual funds and they are tracking live prices or live data, the effect of movement of what is happening in the market on the mutual fund is far superior than on the fixed deposit, which is primarily priced by the bank. So if there is a sophisticated investor, that sophisticated investor, I think, will definitely see that there is a better spread and would want to stick to mutual funds. But retail, in my opinion, will shift to, let's say, NCDs or banks. When we talk about gold, I think gold ETF, sorry for making this statement, but I think the market is dead. Why would you want to invest in a gold ETF when there are no tax advantages? Whereas even a physical gold or an SGB gives you much better tax advantage, and SGB gives you interest over and above the tax advantage. I think that market is dead. And so basically I think what will now start happening is that a lot of this money, which was initially proposed to be on the debt side, will start moving to this category called equity savings fund, right? A lot of these balance advantage fund kind of categories will come in, because conservative hybrid as a category is also dead in this ecosystem. So I think a lot of this money will get pushed to equity savings and balance advantage fund category.
Okay, so I'll get back to you on that, because we do have a lot of queries coming in from our viewers as well. Kamna Biswas writes to us from Kerala. She asks that in light of proposed amendments with regards to debt mutual funds, international funds and gold funds, of course, what happens to lump sum investments between today and 31st March? Will these qualify for indexation benefits as it is right now? So of course it's applicable from first, but Kirtan, what do you make of it? Now, even if it's for 10 years, you will not be paying it as per indexation or 20%. Your thoughts here?
So Sonal, ideally what will happen is you might see a lot of long-term money now coming in before the 31st of March to make sure that you are able to lock in. So to give you an example, you have a Bharat bond 2031, right? There are, I'm sure, a lot of sophisticated investors who would want to lock in this indexation advantage up to 2031. So I'm sure there is a lot of money that will come in here, but largely from a retail investor standpoint, I think this product is largely non-material going forward. A lot of this money, like I said, will definitely move to fixed income, is because, you know, it is so difficult to convince a fixed income retail investor as to why mutual fund will give them 0.5% more, right, versus a fixed deposit that you know for sure will pay an X amount at the end of the year, right? For 0.5%, which is not very comfortably convenient, or maybe you can't put down a thumb and say you will get this amount, but you largely expect 0.5% more than a fixed deposit. A retail is not going to get enticed towards that product.
So that means if they actually buy it before 31st March, they will get the indexation benefit, but after 1st April, it's not.
Oh, absolutely. So up to the 31st of March, you can buy as much as you want and you still get the grandfathering advantage. But 31st of April and beyond that, you will lose this.
Okay, Mohit, you want to come in on this as well? Do you think we're going to see a bit of a rush before 31st? And do you think that's something that you would even advise someone to do if they are looking at this category?
Look, Pavitra, so I think we've had some maddening rush of investors calling in since morning on this subject, and I think apparently most of them are keen to put in monies because, look, there are two parts to it. One part is obviously the tax advantage, and the reason for anyone's investing into a product should not be tax advantage. The second part, which is the most material part out here, is investing in long bonds a good call currently, right? In the current context, I think all of us would agree that interest rates perhaps might see a 25 to 50 bips hike more, but from next year onwards, you will see a rate cycle softening, right? And in that zone, long bonds or long duration bonds, or as Kirtan said, a Bharat bond 2031, 33 kind of papers, those will hugely work very well for all the investors. So as far as we are concerned, we are asking all our investors, if they were waiting on the sidelines for the rates to yields to go up a little more, I think this is the right time. You get an additional indexation. If anyone is investing even with a 3-year kind of a view, you make those 4 indexations. If you invest before 31st of March, you obviously make good the tax advantage, and then your yields are looking very attractive. Though the yield curve is quite flattish, but on a 2033 kind of paper, you're making roughly around 7.5 to 7.6 YTM right now, which to my mind is fairly attractive. So yes, of course, investors should get into this category before 31st.
Okay, we get that point, and we are continuously analyzing that as well. Kirtan, I wanted to speak to you about this big debate now that's happening between fixed deposits and debt mutual funds. That was always there, but of course it favored debt more earlier, right? So we have a query on just that. Pratik Bhavsar writes to us from Mumbai. He asks if the new proposed amendments will make fixed deposits more lucrative as returns are taxable over a period of FD tenure, which will not be the case for debt right now, or should someone look at some other category overall?
See, I think from a retail standpoint, you have 3 options largely, or let's say 4 options. First is you say you want to do fixed deposits, right? Second is you want to do NCDs. A lot of these high yield NCDs will suddenly become the flavor of the season now. You probably can do secondary market bonds. So there are a lot of these bonds which are already listed, right? And the fourth is debt mutual funds. Now, if you look at it from a retail standpoint, the biggest problem that a retail investor typically has is that if she has 10 lakh rupees, that entire 10 lakh rupees will get allocated to one bond or one FD. So in that context, you will not see a lot of diversification advantage that the retail investor will typically get. In that sense, the debt mutual fund category is still far superior. Also, if you look at it from a 3-year standpoint, and like Mohit rightly pointed out, we are probably at the end of the interest rate cycle, right? So when interest rates will start falling, you will also see capital gains that you will get on investing in the debt mutual fund side, right? So from a 3-year standpoint, if there is a retail investor who is looking at investing right now in the debt mutual fund, not only that the accrued interest or YTMs are higher, but because when interest rates will go down, they will also make a lot of capital gains, which is not going to be possible in fixed deposits or any other product as such, right? But again, the disconnect here is that, can I put a number and say at the end of the 24th month or the 30th month, how much is your debt mutual fund going to make for you? The answer is no, right? But that is the advantage now that the fixed deposits and all the other kind of fixed products will bring on board. But if you really ask me, I think still from a 36-month standpoint, debt mutual funds are a far better option to invest in versus doing a fixed deposit or any of these secondary market bonds.
Okay, Kirtan, you also tweeted on arbitrage, so I'm going to come and ask you on that because, a lot of people don't understand this. So if you could just take us through that. You're saying why not have 40% arbitrage in debt? I mean, it still keeps the debt flavor, right? So that's what you're trying to bring across?
Pavitra, there is a small confusion here and I'll tell you what. When you look at the 2018 circular from SEBI, it very categorically says that a debt fund should invest in debt. And arbitrage from a taxation standpoint is equity. So I'm not really sure if the 2018 categorization rule will really allow the industry to do arbitrage in debt mutual funds. But I think this is a very small request that the industry together can make to the relevant authorities, saying that arbitrage as such is not extremely volatile, right? So if you can allow 35% or 40% of arbitrage in debt mutual funds, I think still you will be able to keep the indexation advantage
while allowing this,
and there will not be a lot of volatility in the portfolio. So if at all industry can come together and push this across, I think it'll be a great saving grace for debt as a category.
You should ask Mohit about this as well, right? Mohit, what do you think of this suggestion?
Look, I think arbitrage is the only arbitrage left on the street. Honestly, in terms of category, I see a lot of short-term money in debt moving to arbitrage and equity savings category. But what Kirtan is mentioning is that having some allocation of arbitrage into debt. Look, I don't know how much will SEBI relent on that, because finally arbitrage is an equity class. There is some element of equity, there is some element of futures and options, and debt by nature is very, very safe and very different. So allowing arbitrage so that the category gets over 35% equity and hence becomes a little efficient in taxation, if that happens, great. But I think overall, I think the broader context out here, Pavitra, to understand is basically, I'll just take a step back on the previous FD question also. The reason why this is happening is because if you see as a percentage of household savings, fixed deposits were 6.36% last year. They've fallen down to 2.3% this year, which is 2022, right? So this is a big change in the pattern of household savings, and that's what has kind of pushed the finance ministry to take this dramatic step and plug all the arbitrages or tax arbitrages which were available in the system. So my whole sense is this is very difficult that something will be given out or doled out to soften this entire blow. I think this was waiting to happen someday. It's just that it's come out of the blue for all of us. So
it has been out of the blue, right? Actually, gentlemen, we are enjoying this conversation. We have to take a quick break, and on the other side, we'll continue and try to address all the queries that we've been receiving as well. Stay tuned for that. Welcome back to Mutual Fund Corner. Still have with us Mohit Gang and Kirtan Shah to answer all your queries with this big amendment that has come through as far as debt mutual funds and taxation is concerned. We'll continue to talk about some queries that you all have written to us. Gaurav Bhumaj writes to us from Pune. He asks us if it is wise now to buy bonds directly without any mutual fund route. He also asks what is the taxation for direct bonds, government bonds and corporate bonds. Kirtan, your take on this.
So Sonal, first of course, idea is that when you go and buy a bond, right, the problem with a bond is that the ticket size is slightly higher and for all practical purposes there is no liquidity, right? So let's say if the bond is supposed to mature 5 years from today and you want money at the end of the third year, most retail investors, I can tell you, don't even know where to go to sell the bond, right? So that's one big problem. Of course, you will have a huge influx of people reaching out to retail investors saying that there are high yield bonds available, but always keep these two things in mind along with concentration risk, that you put all your 10 lakh rupees in one bond and if something happens to that company, you know the principal is at risk. Having said that, on the taxation bit, definitely these bonds theoretically have an upper hand now versus the debt mutual funds, because if there is a listed bond, right, and if you hold it for 12 months, you are only taxed at 10%. Right? And even if it is an unlisted bond and you hold it for 36 months, you are taxed at 20%. So for somebody who's in the 30% tax bracket, this looks a lucrative option. But I'll tell you a problem here with the theoretical math, that if you buy the bond when it is issued and you hold it till maturity, there is practically no capital gains. Right? So the interest that you receive, you are still going to be taxed equivalent to an FD or now a debt mutual fund. Right? And because there is no liquidity and the retail does not understand when to buy and sell to make capital gains, retail will really not be able to take advantage of this tax differences that we are talking about. So largely all said and done, I think the retail will not be able to make a lot of out of this, even if there is a small tax advantage versus the debt mutual fund.
Yeah, no, that point is completely taken. Mohit, I want to come to you on this as well. Take us through what you think. The question is, should you directly buy bonds? But it doesn't take away from the fact that, a debt mutual fund is still a professionally hand-picked, set of bonds.
No, I think what Kirtan said is absolutely right. And just to supplement that, look, when you go and buy bonds directly, you have to be perfect in terms of knowing the credit quality of the bond, assessing the company, its management, and knowing a much more detailed. It's like going and buying stocks directly, and why do you want to buy through a mutual fund? The same logic applies when it comes to debt. You buy through a mutual fund because you get professional management, and obviously the fund manager is not just making returns by virtue of accrual or the coupons. He's also trading in and out of the bond. He's moving up the yield curve or going down the yield curve and trying to enhance those returns. So I think those added advantages are there. One more point which we are missing in this entire thing is that mutual funds will continue to provide you set of gains or set off your losses in succeeding years, which a fixed deposit or a bond will not be able to do for you, right? So when people compare fixed deposits, yes, the taxation is now at par, but in mutual funds, you can carry forward your losses, or if there are existing losses, you can set it off against your gains. So that added advantage will continue with mutual funds, of course, and the yields remain a little higher because of the fund managers trading in and out. So to my mind, honestly, I think mutual funds and debt mutual funds will continue to remain a good investment avenue. However, they will lose a lot of sheen because of this whole tax impact, and maybe some of the HNIs might prefer a direct bond route or some other route, perhaps arbitrage or some other equivalent opportunity, which time will tell. But yeah, I think there is some impact.
Mohit, let's talk about the second level impact of all this, because you have spoken how it could move to other categories. Would it move to a different asset class altogether?
Oh, yes, absolutely. And I think in all these changes, Sonal, it's a great question. I continue to believe that when regulators bring about these changes, they sometimes fail to imagine or anticipate the second order and the third order impact of this entire thing. Now, just to come at a basic Indian household, he will first go and invest in an FD, and then he was going and investing into mutual funds. It wasn't the other way around, that investors were first investing into debt mutual funds, and if there was surplus, they were going into FDs. It was FDs first and then the debt mutual funds. Now, once you close that avenue for him, what will he do? Perhaps he might still start moving monies to physical assets, right? The money can move into real estate or even physical gold, because that continues to give him indexation advantage. If you're plugging the indexation advantage on mutual fund or gold mutual fund as a category, you might just plug it on physical gold also, right? But that's still open. So investors can translate or move that money into physical gold or perhaps into physical real estate. Let's say REITs and InvITs can again become a popular category in this scenario. So to my sense, investor behavior will change dramatically. I think one very big impact which this might see is tax planning, perhaps for a personal finance guy like me, or when you do retirement planning, there is no long-term safe avenue available now which can fight inflation. There is not a single instrument left now which will give you inflation adjusted returns or higher than inflation adjusted returns on a long-term basis. There's only PPF left, which also has a finite limit of investment. So the entire investment psychology or investment behavior might change. It might dissuade some long-term savings from moving into debt. Retirement planning for people will get difficult. Corporate bond market might get impacted. A lot of money was moving into instruments like Bharat Bond. It was a big source of revenue for government to collect monies. So these are all second order and third order impacts. These will all play out in few months, and no one knows how the entire industry will be transformed. But to my mind, this is a very, very significant tectonic shift in behaviors of investors.
Oh, absolutely. And this is a really concerning point as well, right? I mean, we've spoken so much about where does money move? Does it move to hybrid? What will happen to the flows? But what will happen to someone who now suddenly has to change the entire retirement planning situation? So all of that are, those are important points to consider. But Kirtan, Mohit, it's been a pleasure to have you on this show. Thank you very much for taking out the time for, really speaking to all of our viewers as well and addressing these individual queries. We're going to wind down on that note, but you stay tuned. We have lots more coming up.